Entrepreneurship World Cup.
That's right.
Yeah.
That's good. Yes, good memory. Much better than mine. Thanks for inviting us. Thanks for having us. Are we live already?
Uh, we are streaming live to Facebook, to YouTube. But you can start it in about 3 minutes.
Okay, great. I'm just gonna finish a few things. I'm gonna put on mute, and I'll be back in 3 minutes.
Okay.
Thanks, Trevor. Okay. Welcome everyone. My name is Michael. I'm from Connecting Founders, and I'm really excited to be joining you today to be discussing and sharing our experience in helping entrepreneurs in their journey of capital raising. We're very honored to be having been invited um, on this auspicious occasion because we really truly believe in entrepreneurship, and it's really the engine, the silent engine that moves economies and society forward. And when we support founders, we're nothing short but inspired by the journeys that these entrepreneurs, these founders have to take. And so we as Connecting Founders, we were founded on the belief of being able to support specifically female founders in this journey. And so what we'd like to do is share the lessons that we have in our collective experience as fund managers, as investment bankers, as investment managers ourselves, that we've been working in the region, Southeast Asia, and a lot of us have been working globally. So we have experiences that we'd like to share, and we'd like to be able to also provide some, I suppose, nuggets of wisdom, if we could say that. So with that, today we're going to be talking about one question that I think comes up often when we meet with founders is the question on when is the right time to raise capital. And I think we have about 45 minutes for this session. And so we're going to go through a few slides. And what we're going to try to cover during the session is to give you a short answer to start with on when to raise capital, the steps that you actually need to do before you go fundraise. And what this section is really going to cover is what you need to ask yourself before going to the market. And then I think a very important point that we'd like to touch upon today is your cost of capital, what investors don't tell you. This is what I believe would hopefully help those entrepreneurs thinking about the next phase and next stage of their growth, and what considerations and what factors you need to be asking yourself, and what you should be aware of with the kind of funding that's available in the market. So with that, we start with a very simple question on when to raise. And sorry to spoil it for everyone, the quick answer there is when you are ready. Pretty sure a lot of people are familiar with the cliche that life is a marathon and not a sprint. This really applies when you're doing business and any venture. Obviously, there are a lot of very successful businesses that have grown the last couple of decades just simply on market demand. Those truly sustainable businesses are the ones that plan purposefully, the ones that last and really build products and services for the market are those that intentionally put their plans in place so that they can be beneficial to not just their customers, but their employees, to the communities, to their stakeholders. And in order to do that, it's a very big responsibility that you need to plan ahead and make sure that you do not come to a point and you are resilient in a case like what we had in COVID, which has been affecting a lot of people globally. But what we'd like to take from that lesson is that even in business, when you go forward, you don't go to the market unless you've actually had an idea that in 12 months' time, you are going to be growing. So when we say when you're ready, it means that you actually come to a peace of mind, a point in your life, a point of your business where you've actually thought about, where am I going to take this business? Where am I going in the next 5 years? And how am I going to get there? And in fact, this is the segue to the questions you need to be asking yourself, because going to the market is only a point that you can reach after you've answered these next questions. So looking at your business, and in whatever industry you're in, whatever sector, whatever product or whatever service you're offering to the market, and despite whatever growth stage you are in, these are the questions that you must know. And they might sound very familiar, or intuitively you might know it, but I think it's just good for everyone to get on the same page, and we just go through it very quickly. The first one is really, I think, understanding your break even, right? I think, again, entrepreneurs that have been doing this for a long time, intuitively they know what they need to make to pay the lights, to pay the rent. But it's an important question, because when you combine this with the next two questions that we're going to show later on, you really determine what kind of capital, what kind of raise do you need to go to in the market. So knowing what your break even is another way to put it actually is how much do you need to not make money, not to lose money? How much should you actually be generating just so that you can operate? Because if once you do this exercise and you find out that you are really pricing out of the market, this is a very solid test, first step to find out that maybe you should be in a different line of business, or you should adjust your service or product according to what the market is willing to pay. And so a very cold calculation is actually just finding out how much you need to cover on a monthly basis, and knowing what that is, whether it's your rent, your salaries, your staff, you must be able to cover that. And based on that, you know how many units you need to sell and how many service hours you need to provide to your customers. So I promise you this is going to be the only formula we go through in this session. And it's really not going to be intensive, but just to put everyone on the same page, your break even is basically your fixed cost divided by your fixed expenses percentage. And your fixed expenses percentage is a function of what is not your variable cost. So in any expenses that we have in our business, whatever business, again, you are in, whether it's cars, manufacturing, you're a tech company, or healthcare, or in food and beverage business, you have your monthly cost, and there are only two types of cost: your fixed cost that are fixed no matter what happens, and then your variable cost, which, as the name suggests, adjust according to the number of sales or revenue that you have. You know what your fixed costs are, and you also have a sort of good estimate of what your variable costs are going to be. A rule of thumb here is that whatever you buy and whatever you source, you're going to be selling that 3 times to the market in order to cover your fixed costs. So that's about a 30% variable cost as a rough estimation. Any business obviously changes, but assuming that 30% is your variable cost, which means the remaining cost that you have on a monthly basis, your fixed cost is 70%. So just to show you the very, very simple example, if assuming that you have variable cost of 30%, that means that your fixed expenses as a percentage of your total cost is 70%. And let's make a very simple example that assuming your rent, salaries, staff, the lights, electricity, again, fixed cost is only 70. So 70 divided by 70% means you need to bring in 100. And I didn't purposely put this, whether it's baht, dollars, Australian, or krona, or rupees, because it's the same everywhere. And you can do this the same with hours for a service business. Basically, you need to know once you have 70 cost and you need to bring in 100 of whatever that is, then you can start to divide that by the number of units that you're selling, whether cups of coffee, hours, or cars. So this very basic number, which again might sound very simplistic, but it's literally your first step in saying, am I breaking even? If I'm not breaking even, then what is it that I need to do? Am my cost too expensive? Do I need to be able to adjust my sourcing? Am I paying my rent? Is my rent too high? And knowing this is your first step in finding out, okay, looks like we've got a lot of challenges that we're facing, and what do we need to actually change? So this is just one part of 3 questions that we will go through in your journey, because obviously this raises more questions. If I'm not breaking even, what do I do? Is that the reason why I need to raise money? You need to combine it to the next question is, after you know what your break even is, okay, you know how much you need to bring in to maintain your business. What's going to change in the next 5 years? We're not talking about having a crystal ball and knowing exactly what life is going to be in 5 years. As we all know, 2020 affected everyone, and no one had any plan that was resilient enough to anticipate a black swan event such as 2020 happening to everyone. But that doesn't mean that you don't have plans. The purpose of planning is to be prepared when plans do change. So the question of actually sitting down with yourself, your team, your co-founder, your board members, and saying, we're growing, and this is how we see the future, how we see ourselves in that future, how we see ourselves serving our market, serving our customers, how it is going to be like in 5 years, and what are those challenges going to be like in the next 5 years. We don't know. There's so many of them, so many scenarios that you can lay out. But the purpose of this exercise is not to map out all the different scenarios that's going to happen, but it's to basically come up with actually 3 scenarios. You know, your normal situation, if things don't change, nothing improves, nothing goes bad, what's going to happen in 5 years, what you anticipate is your base case. What happens when things really, really go well, when your market expands, your product and service blows up and it really reaches, are you going to be global dominant in the next 5 years? Or are you going to be regionally dominant? Or are you just going to be community dominant? What is it going to be different than what your business is today? That's your best case. And then obviously you need to have some sort of downside scenario where you do think that if all these plans don't work out, if our assumptions are not right, if our assumptions are not validated, what's our business going to look like? There's a famous slide that I'm sure it's available when you look it up on Google, Uber's deck when they went to the market, when Travis and his team, the original co-founders, brought the original idea of renting cars to the market. They had one slide in the end that just basically said what would happen to them, what would happen to investors, what would happen to the people who entrusted their business if there was the worst case, and what would happen in the base case and what would happen in the best case. And I remember looking at that slide and saying it was a very smart way of approaching it, because they said we have very ambitious goals of becoming global dominant, an Uber car that you can order in your app available. Although, as you can clearly see, that it really worked out for them. Their base case was that they're going to be dominant only in America. And in the worst case, they said that they'll have a very expensive taxi service. And there's no shame in actually putting that down. But that was a plan that they said that if we don't work out, if our plans don't pan out, and all our investment and our resources, our time and effort to push this venture forward, what will all that result in if things don't work out? And for them to even have the humility to say that we are going to be a taxi company in 5 years was a way for them to prepare for the any potential dilemmas that happen in those 5 years. So that is all to say that there's a careful planning exercise that needs to be done, and you call it whatever it is, your projections, your business plan, your 5-year outlook, your cash flow forecast. All of those things have a meaning behind it. It's to prepare you for when things don't go the way that you have planned them originally. So when you combine these two questions, the first question is, am I breaking even? How much do I need to actually break even? And then when you look at your plans, what am I going to be in the next 5 years? These two questions actually determine what kind of funding you're looking for. Because if your break even is in a relatively mild state, and then your change is not going to be so great in the next 5 years, maybe you don't need capital raise. What you need is to just improve your cash position. Your cash conversion cycle needs to just be improved, which means a net working capital improvement. So asking these 2 points, asking these 2 questions allows you to be able to determine what kind of capital you're going to be looking for to raise. Now, the next question, when you combine these 2 points of what is my break even, and then what will change in the next 5 years, is then what do I need to get there? As I mentioned earlier, again, if you determine that you're going to have stable, steady growth, you're a mature business when you're already earning $10, $20 million, and you're just growing steadily, what you might need is just a working capital line, a credit card basically, that helps you make sure that you make ends meet on a, not for expansion, but to make sure that your payables and your inventory are being converted efficiently. But for those ventures, entrepreneurs starting out, the idea of actually growing a business in a way that would reach those ambitions that you have requires you to consider a capital raise, which brings us to the next point on how much that's going to cost you. So just to summarize, steps to fundraising, which means coming back again to the point of how do you know when you're going to raise money is when you're prepared. You have to ask yourself these 3 questions. I'm breaking even. And in the first situation, I'm breaking even. Nothing's going to change that much in the next 5 years. And all I need actually is just to improve my marketing, or my rent needs to be lowered. Then you don't need to raise capital. You just need operational improvements. You just need to tweak your current setup and make sure that you're optimized to capture the current environment. However, if you go to these 3 questions and you find out that I'm not breaking even because I'm really growing, I'm spending a lot of money on marketing, I'm spending a lot of acquisition for customers, spending a lot of tech development, because in the next 5 years, I'm going to be globally dominant. my product or my service is going to be in every household in every country in every single continent, then the obvious question that you're going to be looking for then is, I need capital, and I need capital now to accelerate my plans. So the last section that I just wanted to cover, and we're going to get into some detail, a little bit more technical, but it's something which I would like to share, again, with our experience with working with founders and raising capital. When you do decide that you do need to raise a substantial amount or a good chunk of capital, before you even start to ask whether it's debt or equity or any types of funding, you need to understand that there is the cost of capital. Again, entrepreneurs, well-founded entrepreneurs with business folk who've been doing this for a long time know this very intuitively. But just to make sure that we're all on the same page, just want to make share just a view of like what investors perhaps don't say in the fine print when we're raising capital, is that really everything worth doing is, as you all know, is hard. So is capital. Nothing's free, and any capital that you raise has a price on it. And the first step for you before going to the market, once you've answered your 3 questions, yes, I do need to raise money, is to determine your cost of capital. First and foremost, your cost. Now, before I get into this slide, I wanted to actually just talk about the different kinds of capital that's available in the market. And most of you might be familiar with this already. You've got, obviously, the first one is equity, which is the most common type of funding that venture would be looking for. And the bottom is loans, when you are stable enough that you can get bank loans or any facilities from the market. There is also something in between, which is something called a hybrid, which sits right in between an equity and a loan, is a mezzanine loan. What is important about this is not the features, it's actually the cost of them. Because when we are looking at giving away equity in our venture, you have to understand that, as I mentioned, the cost of that grows over time. So equity, when you might hear the common saying of like 3 times, 5 times growth, that actually translates to what you're paying much, much higher than your bank loans of 5 to 7 to 10, anywhere from 26% all the way to 83%. That's literally what the cost of equity is when you give away equity. When you raise money in the market privately and you give away equity, you might be thinking to yourself, well, you know, I don't want to pay back the loan. I don't have any revenues. I won't be able to pay back the loan. So of course I have to give equity. Obviously that's the one choice. But you must be cognizant, must be aware of the fact what this really truly costs to you. You have to give equity in the beginning. When you do give that equity in the beginning, you have to be very conscious, careful, purposeful about it. We'll come back to the slide. I actually want to go through this very quickly. So we've established now that we're raising capital and we're talking about the ones that are big venture, big bets. So you need to be giving away equity. So as we mentioned earlier, yes, high risk ventures require big, bold bets. And as we know, even though you made your plans, they don't always pan out. You know, milestones are not met. And then as we've established in 2020, COVID happens. So I'm going to skip a few slides. I wanted to mention that, again, because of the cost, preserving your equity, because equity is the most expensive form of financing in the world. Again, it's something which you may know, but it's something which you need to, once you see it, sorry. Sorry. So what we'd like to share and make this point is that when you do go to the market, when you consider the alternatives and the options that you have, One of the important things to note is that equity is the most expensive form of financing. So with that, how do you prevent yourself from not giving away too much equity? In the sense, some companies, this may not be applicable unless you have a certain amount of growth and you're a certain level of stability, you have revenues already happening. But what I'd like to let people know and be aware of that debt is not a dirty word. Tailored properly, structured properly for the right kind of business, for the right time and the right moment in your growth, debt is an appropriate instrument once it's structured properly. So this is to the point of when I said what investors don't really reveal is something which is actually top of their mind whenever they are evaluating a business opportunity when you come to the market. What do investors really want? Obviously, they want to make money, they want to grow, but the most important thing for investors is that they are in the business of capital preservation. So capital preservation for them means that they are top of mind, making sure that they not just make money, but that money is the cushion and protection that they need so that they don't lose their pool of capital when they invest in different ventures. I'm going to share with you some numbers in the market. So you might have heard the common wisdom of 8 out of 10 investments, not businesses, 8 out of 10 investments fail. This is something which has been well studied. Most famous of them being the Kauffman Foundation, which they did in 2012. Kauffman Foundation is one of the largest investors in private equity and venture capitals in the world. And so they have the largest data set and historical track record of actually looking into the markets, what they've invested in. And they've been very generous to share these results to the market to inform that only 20 of the 100 VC venture capital bets that they have made have actually beat the public markets. It's not a very, very strong correlation or high ratio. Another way to say this is that 4/5 of all VC investments have failed to preserve their investments that they receive. All of this is to say that venture capital is a very risky business, is a very, knowing that there's a very high chance of failure for investors, top of their mind is to make sure they preserve that capital. And that's the reason why demand is such a high cost of capital. And that's the reason why they have a desire to get a 5 to 10 times return for venture capital bets, because they're trying to compensate for the losses that they will be making in their other investments. I'm going to skip a few things here. Let's not go through this exercise. So coming back to this slide, I wanted to mention that. So because from the investor's point of view, when you raise capital from the market and you have to give away equity in the beginning, you have to be conscious of the fact that because investors are, their fiduciary duty, institutional investors, are to protect their investor, their client's money, and to protect that capital, they're going to need a very high cost of funding. So this 3 to 5 times return over the period. So the top column shows us the number of years, and we've just chosen 1, 3, 5, 7, 10. The type of returns that they're looking for, whether it's 1x to 2x to 3x to 5x to 6x, this is the corresponding rate of return. Rate of return is basically the cost that you're paying to access this type of funding. So if an investor comes and says they're in the equity and they're looking for 10 times growth over 10 years, so you look at this right column, 10 years, 10 times, they're basically asking for a cost of capital of 26%. Likewise, if they want a 5 times return over 7 years, that's also 26%. But if they want, let's say, a 3 times return only in 7 years, then that's an 18% return. Likewise, it comes down lower and lower, so it's only 2x over 10 years, 7%. The idea here, or the concept here, is that the red column just really shows you that for the longer time that you take someone's money, institutional investors' money, individual investors' money, and you have to pay that back in the form of mezzanine or in the form of repayments or in exits or in trade sales when you go to the public markets, this is the cost that's affecting that type of financing. What does this mean for your business? Obviously, when you started a venture, you're hoping to make money for yourself, for your community, for your employees. And then the more that's being siphoned out because of the financing you get, the less that's available for you and what you intend to do. I know that sounds very obvious, but this is an important consideration. That's why it's important to come to that 3 questions that I asked earlier. What type of growth you're doing? Because if in the next 5 years, you are going to be globally dominant, every country, every continent, then you do need rocket fuel. That kind of rocket growth, you're going to be literally 10x in the next 10 years, does require a type of octane gasoline, which is capital that's very expensive because you're going to be growing very high. And so that's where it's warranted. However, if you're going to be a stable, steady growth, conservative business, which the world is littered with very great examples of this. Berkshire Hathaway, one of the most famous investors, obviously in the world, is known for choosing and picking companies that are stable, railroad companies, insurance companies. They're growing steadily stable over decades. They are organically driven. They are grown by what we hear in the market: bootstrapping, customer acquisitions, organic growth, internal savings, cost savings, internal optimizations, and working capital lines that allow them to grow slowly but steadily over time. Then you are looking at cost of capital in the loans or mezzanine level, and that is more appropriate for your business. And so that was a very rapid entry into the different cost of financing that's available, and that's supposed to give you the overview of what type of funding cost, or what we said, what investors don't automatically reveal to you. They do so in different ways, but just to put that up front and center, it's really the cost of capital that will be siphoned from your business. We may have time for a very quick example to illustrate this expensive cost. We presented this a few months ago, and it seemed to have stuck and resonated with some audience members. And so we'd like to take this opportunity to illustrate this example that we shared, just to illustrate what the cost of capital looks like. Back then, we were using an example of Jeff Bezos, Amazon, which we all know is the largest company, the most successful startup that ended up being very dominant. Jeff Bezos, the founder, famously quipped that his biggest regret was giving away $10 million for 20% of his company early on in the life of Amazon. And that 20%, as you can see, business now, the company is worth trillions of dollars. That cost of capital cost him much, much more than he just got a bank loan. And this small example illustrates that. So we're looking at a consumer goods business. It's been in operation for 5 years. And In 2019, it made $1 million in revenue, and it has about 20% EBITDA, which is your earnings before interest, taxes, depreciation, and amortization, which is what investors always like to look at. It's a good measure of how much cash is available after your, what we mentioned earlier, your fixed cost, your variable, and your fixed expenses. And so they have determined this particular company has already gone through the exercise that we've gone through earlier, those 3 questions, and they've determined that they need 1 million to expand their products using proprietary technology. And so they're looking to raise capital. This, by the way, is actually a real life client of ours. And the numbers are very close to what we're looking for. So just to show that this particular company had an ownership base that was comprised of 70% founders, and the remainder were angel investors, early investors in the beginning. And the last valuation, when they raised capital, priced their company at $4 million. So very quickly, at 2019, on the left side, going to 2020, your revenue is the same. It's flat because of COVID. Assuming you do your valuation with the help of advisors or with the help of your investors, you have a valuation of 4 times. In the last round was 4 million, and then you raise money now at 5 million valuation. You're giving away $1 million. That's 20% of your company. If you recall, the founders already were diluted down to 70%. So the founders had 70% of this company. They raised $1 million for 20%. And that 20% is 1 million of 5 million. So now the founders have gone down from 70%, giving away 20%. They're now at 50%. They only own half of the company. Okay. Now, what happens in 5 years? And yes, these are assumptions, but assuming things do go well. So this company that had 1 million in revenues in 2020, 5 years later, they 20x'd, right? They've got 20 million in revenues. Things are really, really going well for this company. And because they're doing very well, the market has awarded a very high multiple because, again, they're using technology. So 8x in the top higher end of the revenue multiple. So the value now is 160 million, 8 times 20 million. So the stake of 20% that they gave away 5 years ago is now 32 million. That's the valuation of 160 million times 20%, so that's 32 million. Now, what is that cost for that 20% stake that they sold 5 years ago? The $1 million that they gave away, this company that gave away, has now grown to 32 million. That is, I'm sorry, literally an 83% growth. Looking at going forward from year 5 to year 7, same thing, from 20 million, they go to 35 million. The valuation goes up to 10x, which is now, again, the market's preparing them for an IPO already, or even this is the point where they're actually going to be bought out by a big conglomerate. The valuation now is 350 million at 10x. The value of the stake of 7 years ago was 1 million. In 5 years, it became 32 million. And in 7 years, it became 70 million. So 1 million to 70 million over 7 years is a cost of 83% per annum. Again, this is something which is not placed on your term sheet or in an offer, that when you give away 20% of your company, we're asking you to pay 83% in interest every year. Of course not. This is absolutely a bet that may or may not happen. But this is, again, coming back to Jeff Bezos' famous comment, was that because this company has grown more than 10x, more than 20x since the time he founded it, the equity that he gave away in the beginning, that growth, as you can see, from 1 million going all the way to 32 million in 5 years, all the way to 70 million, that's 70 times growth for an investor. if you compound that on an annual basis, that's the equivalent of 83%. So when we put this on the slide for our clients or to founders, then all of a sudden when we show them what the alternatives are, you can raise debt funding, you can go to the bank. Yes, there might be security requirements, collateral requirements, but they're going to be asking you for maybe 10% per annum or 12% per annum, or maybe even 15% per annum. A lot of people balk at that. Like, I will never pay 15% on a loan. Never, 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 never. But they're very happy to give away 83% per annum when you give away equity. So not to say that you don't give equity away. I just want everyone to be very conscious of that cost. That when you're considering a debt raise, when you're considering a loan, don't look at it as an expensive option, because again, the most expensive option is giving away your equity. So I hope that was helpful. We were able to go through this in 40 minutes. But I think those were, I just wanted to keep it a very short session on leaving some questions that would be what we believe is going to be important when you consider if you're going to raise capital for your business. This is something which we've seen time and time again in different businesses, in different stages, whether you're a startup, growth stage, even in recovery. All businesses in any sector that you're in, and we've been fortunate to be involved in companies in different countries. The same questions come up when people are considering how to bring their business forward. Again, knowing you need to be prepared if you're going to sustain your business for the next 5 years. To even know where you're going to be in 5 years, do you know that you're surviving today? If you're breaking even, and if you know you can break even, and then you can be in a different position in the next 5 years, that really determines what kind of capital do you need to grow your business, whether it's just going to be organic growth, working capital that you need, cheaper forms of money because it's stable growth, or you're going to be a rocket ship, and a rocket ship requires a rocket fuel, and that rocket fuel is in the form of venture capital, and that means you are going to be giving away equity. And we are all for you having to do that, because you are in a business that's definitely going to change the world. And so you do require that equity investment. When you do that, we hope that you are conscious of what it costs to you when you consider this as an option. So with that, I hope that was beneficial, and good luck in your entrepreneurial journeys.
Thanks, Michael, for a very informative session. I think that brings us to the end of the session. I think we still have like a few minutes left. Maybe you can also use this time to tell people, to tell the audience what Connecting Founders does, in case maybe they're interested in working with your company.
Sure, thank you, Trevor. Connecting Founders is an advisory firm that we help entrepreneurs raise capital throughout their whole capital raising journey. We also do provide advice for ongoing businesses who are not raising capital but are looking to reposition, repurpose themselves, especially in the time of COVID. We see a lot of businesses that are looking for assistance. We ourselves were former investment managers. We manage institutional capital. So we have placed money for the big names in the past. So we are very painfully aware of the views and the challenges that investors face. And so we're very compassionate on their approach. And we try to share those questions with entrepreneurs so that they're informed on their journey. What we've really seen in the market is that a lot of so-called education sometimes is too one-sided. So we'd like to make sure that there's both sides of the table, and we definitely sit on the side of the entrepreneur. So that whenever you go out to the market, you're not just being faced by an investor, but you actually have someone that you can bounce ideas, have questions, because we go to the doctors when we have something that's wrong. We don't self-diagnose. It's the same thing for your business. You have executive coaches for those people who have founders who are high-powered and they're looking for a coach. Sports, athletes have trainers and coaches. We do the same thing for businesses. We focus specifically on female founders. This company was founded with the belief that the female economy is an important and necessary segment that needs to be not just promoted, but supported, accelerated. And the more that we have female entrepreneurs, female investors, and also men supporting female investors and providing them the space to be able to accelerate is what we believe is truly important for us. So yes, anyone who's looking to raise capital, looking for advice in their business in any stage of growth, any sector, do reach out to us, Connecting Founders. Happy to help you. I want to make one very important point. This is a female-founded firm. I am the only male in the company. Female-founded, female-led. So just to be very clear about that.
Thank you. Actually, we have another session after this on presenting your language, presenting your story in the language of founders, of investors. So if you're interested in joining that, yeah, it starts immediately after this at 2 p.m. It's with Katarina Maloney, the founder of Connecting Founders, actually.
Exactly.
All right. Thank you, Michael.
Thanks very much. Thank you so much.
Mhm.